This is Alpha. Let's continue our conversation from last time. Uncharted territory for stock technical analysis. Can active trading strategies beat passive funds? In the last issue, we talked about not being superstitious about technical analysis. In fact, it is not as useful as imagined. Next, let's take some widely acclaimed technical indicators as the main indicators of our trading strategy. Use my own test system to do historical backtesting. Exponential moving average EMA, which is the core of the indicator King MACD. This strategy goes like this. When the closing price is above the 20-day moving average EMA and above the 20-day moving average MA. Buy now. Sell when the price breaks down below the 20-day MA or EMA. We call it Strategy 1. First of all, the target pool of the strategy is the 500 stocks held by the SPY fund. The number of stocks is large enough and the company is representative. This can eliminate some of the randomness and bias. The test period is from March 7, 2024 to February 20, 2025. Then, the stock holdings are equally weighted. For example, on a certain day, 3 stocks showed buy signals. Then the purchase funds for each stock account for 1/3 of the total funds. If 2 stocks with buy signals appear on the next day, and there is no sell signal among the stocks held, at this time, you need to sell part of your holdings and use this money to buy the 2 new stocks. Make the funds for these 5 stocks account for 1/5 of the total funds. In addition, this is an ideal model that ignores slippage and transaction fees. The control group has always held the SPY S&P ETF. Why choose S&P ETF as the control group? The reason is simple. On the one hand, it is the best ETF. On the other hand, if you use an active trading strategy, it is not as good as passively holding ETFs. Then there's no need to waste your energy. Let's look at the results of Strategy 1. Compared to holding SPY, the return of strategic trading is about 12% lower. The volatility and maximum drawdown are also significantly larger. Compared with the control group, this strategy was a complete failure. This strategy doesn't work. Let's try another one. This strategy goes like this. When the fast-moving average MA10 crosses the slow-moving average MA50. At the same time, when the RSI is below the oversold value of 70, buy. When the fast-moving average MA10 crosses below the slow-moving average MA50. At the same time, sell when the RSI is above the oversold value of 70. We call it Strategy 2. The target pool and control group are consistent with Strategy 1. Let's see how it works. Strategy 2 is clearly better than Strategy 1. But it's still better to hold SPY. The final net value of Strategy 2 can reach 1.17. This is less than 4 points lower than the control group. But the maximum drawdown is obviously too large. It seems that the strategy trading does not show any better performance than just holding SPY. Is it because the test time is too short? Will the performance be different under different market trends? Okay, let's extend the testing time of Strategy 2. Starting from 2021, other conditions remain unchanged. Let's take a look at the results. The effect is not bad, but the benefits are still nearly 3 points lower than the control group. The maximum drawdown is also slightly larger. Overall, this trading strategy is okay. At this time, careful friends may have discovered a problem. S&P ETFs are not evenly weighted. It is allocated according to the market value. The larger the company's market value, the higher the proportion of funds. The funds for our trading strategy are equally weighted. Although the active trading strategy is not as good as the SPY S&P fund with non-equal weight allocation funds. But we may ask, will the SPY S&P fund with non-equal weight allocation definitely perform better than the S&P fund with equal weight allocation? With this question in mind, let's do a test of holding S&P stocks in different ways of allocating funds. So we build a new S&P fund. Equal weight S&P fund. Its holdings are the same as SPY, the only difference is its fund allocation. An equal-weighted S&P fund gives equal weight to all its holdings. From the graph we can see. The orange dotted line is the change in SPY's net worth. The blue line is the newly constructed equal-weighted S&P fund. Its final net value is about 1.15, still lagging behind SPY. Actually, this is understandable. Because in this bull market, large-cap stocks have risen more. Especially the 7 giants of the US stock market. Therefore, it is more reliable for ordinary people to buy S&P ETF. Buffett is honest with me. After testing this far, we can hastily draw a conclusion. Being proactive is not as good as being passive. After a lot of operations, nothing happens. At this point, the technical community will certainly have different opinions, and we welcome criticism and correction. I will further elaborate on my views in the next issue. Okay. That's all for now. We will continue next time.